Joining us now, been a while, Jack Caffrey, Equity Portfolio Manager at JP Morgan Asset Management, and Marianne Bartels, also been a while, Chief Investment Strategist at Sanctuary Wealth. We had, Marianne, we had Mike Wilson on yesterday, and he just refocused my attention on all the looming problems that this stock market might encounter over the next 6 to 9 months, and made a pretty compelling case for not only a retest of the old lows, but maybe even some new lows down in the, I don't know, somewhere between 3,000 and 3,500 on the S&P. Do you adhere to that viewpoint?
Oh, that came out in December. We said the bull was already running. So we have pockets of the market that are actually reaching record all-time highs or near all-time highs. So you do have some form of bifurcation in the market. But, Joe, no, we no longer believe that we're going to go down and test the October lows. The internals of the market improved greatly on the rally in January and earlier this month. We still say that we can have volatility as long as the Fed is raising rates. But we think the market is going to find some footing here, and it'll actually be a good market between at least now and summer.
Jack, we had Jeremy Siegel and his S&P in terms of what the S&P would earn was a far cry. I think it was at 21 or 2,200. And then we had Mike saying it could be 1,850 or worse. Siegel said it may not even be as bad as 2,200. And Mike said it might be worse than 1,850. So we have no idea in terms of visibility or what kind of multiple to put on those earnings. So you can get to 3,000 easily doing some math, or you could get to perhaps fair value where it is right now.
I guess looking forward, it comes back to this question. In the short term, where do we think psychology settles out on the multiple? And right now, we certainly have a lot more pressure coming from interest rates and the recent backup, particularly in the 10-year, making this discounted earnings into the future. Not necessarily what 23 earns, but what we can look to improving earnings, perhaps in 24, improving earnings into 25 once we get some stability and back to a line of sight. But in the shorter term, markets are bouncing around more on psychology rather than the fundamental drivers of earnings. To that extent, it comes back to, what's the news? And today we're going to be anchoring on what that path to rate normalization might look like.
Do you think Home Depot yesterday, Jack, were there storm clouds in that report, do you think? For the Fed, it'd be good news, I guess, if the consumer is feeling less robust. Does that help them do 25 instead of 50 next time?
Well, I think within the Home Depot numbers, you've sort of got two issues going on. On one hand, you've got margin pressure from their commitment to a $1 billion increase in terms of compensation for employees. And that's not necessarily something the Fed wants to hear in terms of when you start thinking about employment inflation tending to be stickier inflation. I know we've got some better news on rent starting to come down on some of the forward-looking measures, such as some of the surveys out of Zillow, but that isn't necessarily the rent driver that the Fed winds up looking at, which tends to be much more backward-looking and much more slow-moving. Now, the flip side there, though, is Home Depot sits in the issue of the housing market, which has had a substantial contraction as mortgage rates have gone from 2.5% to just under 7% a few months ago, started to see some stabilization, and this is more, managing by anecdote. I had a ride this weekend with an Uber driver, and we were talking. What did you do? He said, well, I was in the mortgage business. Right now, he's driving an Uber. So he finds out not finding himself unemployed, but his primary job actually is exceptionally low right now, so he has to find something else. Does that cheer the Federal Reserve? It keeps the employment statistics looking relatively positive. It talks about finding ways to supplement wages to keep consumption up. But, when you wind up looking for certain pockets, as Marianne mentioned, pockets of the market are going to be under a bit more pressure than others. Home Depot sits more or less somewhat more in the crosshairs as being more housing exposed.